The top 5 things to invest in on a low budget. Many individuals are puzzled by investing. There is a widespread misconception that starting an investment requires a large sum of money. However, investments might begin with a few thousand or even hundreds of dollars. Invest a tiny amount for the long run and be patient in allowing it to develop. But first and foremost, commit to researching investing in private or public funds. In today's video, I'll be showing you how you can invest with a low budget. Stay with me till the end of the video to learn more about it. Without further ado, let's get right into it. Number 1. Enroll in your employer's retirement plan. If you're on a limited budget, even enrolling in your 401k or other employer retirement plan may appear out of reach. However, you may start saving in an employer-sponsored retirement plan with little sums that you won't even notice. This is an important step that everyone should take. Plan to put 1% of your salary into the company plan, for example. You probably won't even notice a contribution so modest, but what makes it even simpler is that the tax deduction will contribute even lower. Once you commit to a 1% commitment, you may progressively increase it each year. In year 2, for example, you can increase your contribution to 2% of your salary. In year 3, you can raise your contributions to 3% of your salary, and so on. You'll notice the higher contribution even less if you time it with your yearly wage boost. So if you earn a 2% salary rise, the money will be shared evenly between your retirement plan and your bank account. And if your employer matches your contribution, the situation will be much better. Number 2. Let a robo-advisor invest your money for you. Robo-advisors first appeared on the financial market approximately a decade ago to make investing as simple and accessible as possible. You don't need any prior investing knowledge since robo-advisors eliminate all of the guesswork. Robo-advisors function by asking you a few basic questions to identify your objective and risk tolerance, and then putting your money into a well-diversified, low-cost portfolio of stocks and bonds. Robo-advisors then utilize algorithms to constantly rebalance and tax-optimize your portfolio. There is no easier method to begin a long-term investment. Most robo-advisors demand minimal money to begin investing and have extremely low fees dependent on the size of your account. All of them provide automatic investment strategies to assist you in increasing your balance. The expense of robo-advisors is the only disadvantage. Robo-advisors charge an annual fee that is calculated as a tiny percentage of your account balance. The industry average is around 0.25%. As a result, if you invest $10,000, you will pay $25 every year. That's not a lot of money, but it adds up quickly if you accumulate hundreds of thousands of dollars. It's crucial to remember that the costs imposed by robo-advisors are in addition to the fees charged by the exchange-traded funds, ETFs, that robo-advisors purchase to build your portfolio. By constructing your portfolio with ETFs or mutual funds, you may avoid paying robo-advisor fees. However, for the great majority of investors, that means a lot more effort and responsibility. Number 3. Start investing in the stock market with little money. When it comes to investing in the stock market, the cost is frequently a deterrent. Isn't it true that it requires money to make money? Not any longer. Consumers may now get started with very little money thanks to the internet. That means you may put a few dollars in to get a feel for investing before making a larger investment. It's an excellent method to learn about investing while risking very little money. Today, there's an expanding number of choices that have opened doors to a new generation of investors, allowing you to start with as little as $1 and charging no transaction commissions. Stockbrokers used to charge many dollars in fees every time you purchased or sold shares. This made it prohibitively expensive to buy in a single stock for less than hundreds or thousands of dollars. $0 commissions across the board have been so effective that they've upset the whole investment business, forcing all major brokers to follow suit and eliminate trading commissions. Furthermore, the possibility to invest in firms with fractional partial shares is a whole game shift in terms of investment. With fractional shares, you may further diversify your portfolio while saving money. Instead of purchasing a whole share, you can purchase a part of a share. If you want to buy in a high-priced stock such as Apple, you may do so for a few dollars rather than the entire share price, which is now over $370. Number 4. Dip your toe in the real estate market. You don't need a lot of money or even good credit to invest in real estate, believe it or not. A new investment category called colloquially real estate crowdfunding allows you to acquire fractional shares of big commercial buildings without the hassle of becoming a landlord. Crowdfunded real estate investments have a higher minimum investment requirement than robo-advisors, for example, $5,000 instead of $500. They're also riskier investments because you will be investing your full $5,000 in one property rather than a diverse portfolio of hundreds of smaller assets. The advantage is that you own a piece of a genuine physical asset that isn't necessarily associated with the stock market. As with robo-advisors, investing in real estate through a crowdfunding platform incurs fees that you would not incur if you purchased a building directly. However, the benefits are clear in this case. You split the expense and risk with other investors, and you're not responsible for maintaining the property or even completing the paperwork to purchase it. Real estate crowdfunding, in my opinion, may be a fascinating method to learn about commercial real estate investment while also diversifying your holdings. I wouldn't put all my money into these platforms, but they're a fascinating alternative investment, particularly in these times of unparalleled market volatility and pathetic bond rates. Number 5. Put your money into low initial investment mutual funds. Mutual funds are financial vehicles that enable you to invest in a portfolio of stocks and bonds in a single transaction, making them ideal for first-time investors. The problem is that many mutual fund providers need initial minimum contributions ranging from $500 to $5,000. If you're a first-time investor with limited funds, such minimums might be prohibitively expensive. However, some mutual fund firms may waive account minimums if you agree to make recurring monthly installments of $50 to $100. Automatic investing is a feature that is widespread in mutual fund and ETF IRA accounts. Dreyfus, Transamerica, and T. Rowe Price are among the mutual fund companies that have been accused of doing so. If you can accomplish it through payroll savings, an automated investment arrangement is especially practical. You can usually set up an automatic deposit scenario through the payroll, similar to how you would set up an employer-sponsored retirement plan. Simply ask your human resources department how to get started. Thank you for staying with me till the end of the video. I hope you enjoyed it. If you did, like and share the video. You can leave your questions and thoughts in the comments section below. And don't forget to subscribe and hit the bell icon to get notified when we add new videos in the future. Goodbye.